Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. As always, I'm your host, Lance Pederson. So today I have with me Arn Cenedella with Spark Investment Group. So Arn has spent, I think, most of his life in the Bay Area, but has made the trek eastward to the beautiful Carolinas and South Carolina in particular. So thank you for joining us today, Arn.
Hey, Lance, great to be here and look forward to chatting with you about real estate.
Heck yeah, that's right. This is the show where guys like us get to sort of nerd out and do so unapologetically. So that's why I enjoy it. I don't have to apologize for myself. We can get into the weeds and not feel guilty. So, but as always, right, we're always looking to, kind of get you, the listener, sort of inside the mind of those who, are in one way or another, really digging into the details for these various investments, so you can kind of see how, those who are active investors and whether they're, investing passively on an active basis or not, just how you sort of assess and look at these sort of investment opportunities with the objective, of course, is making this sort of less intimidating for those who are trying to figure out how to kind of get involved themselves. And also then to open you up to, resources that you can lean on, during your journey through this process. And I think that, Arn is a great resource who's been in the business a long time. So with that being said, Arn, why don't you share with us a bit, how you kind of got interested in real estate and really what ended up leading to, launching this new endeavor, which is Spark Investment Group.
Yes, thanks, Lance. My story about real estate starts way back in 1978 when I got out of grad school, had a master's in physical chemistry, but wasn't sure that was going to be my life pursuit. So I returned to the Bay Area and went to work for my father in a residential real estate brokerage company located in Menlo Park, California, kind of right in the middle of the San Francisco Peninsula. And I've been doing real estate brokerage and investing full time since that time. I've been primarily a single family home investor for most of my life, probably at one point had 20, 25 properties, maybe 30, 35 doors in total. These would have been in the Bay Area, as well as elsewhere in the country, in particular, Austin, Texas, and Charlottesville, Virginia. So I kind of come from a residential background. And essentially my investing philosophy, I just kind of followed in my father's footsteps. He was kind of an old school guy, and he'd buy a rental house here. And, as he went on, I think he kind of understood that investing was really the way to financial security, not so much the brokerage. So it was kind of an old school approach. And I pretty much followed that for 35, 40 years. And enjoyed being a landlord, enjoyed acquisition, selling properties, doing 1031s. And that pretty much continued when we moved to Greenville in 2014. Bought a bunch of rentals in the Greenville area and continued on this path. And then a chance phone call in March of 2020 from an investor buddy of mine about COVID kind of put a light bulb off in my mind. And I got onto multifamily, educated myself quite a bit about it, started transitioning my single family portfolio into multifamily properties. And I'm excited about the transition, and I'm trying to help other smaller scale investors scale up their investing, educating them as to the benefits of multifamily.
Got it. So for you with the whole, like the COVID thing, so maybe a little more detail on that. Like what was the, was it the whole oh my gosh, everyone's going to be locked in their houses, shelter's more valuable than ever, and kind of a nation of renters, or like, how did that?
Yeah, that's a good question. So my buddy, first name's Mario, and he lives in Greenville. I met him when I moved here at the gym. Fitness is kind of one of my passions other than real estate. Mario calls me up mid-March and he goes, "Hey, Arn, what do you think's going to happen with rents now that COVID's here?" And I go, "Mario, I don't know. Ask me April 5th and I'll have a better idea of what's happening." And at the end of the conversation, he said, "Well, let me send you this podcast from a well-known syndicator about the impact on COVID." And I listened to that podcast, and that kind of ignited this little spark, let's call it. And I started consuming podcasts, joined a couple boot camps, and started educating myself about multifamily. What happened kind of similarly is I have a spreadsheet where I keep track of all my real estate kind of value, loan, equity, net income, and so forth. And so I calculated out the cash return on the equity I had in all these properties. And many of my investments coming from the Bay Area were more capital growth investments rather than cash flow investments. The Bay Area is not a cash flow market. And in kind of analyzing the cash flow I was receiving off the equity I had in these properties, it turns out the cash flow return was fairly low compared to the equity. It was realistically maybe 3-4%. And but they're nice properties. They were appreciating. I have no complaints, but I'm also 66 years old now. And so I think as an investor gets older, oftentimes there's kind of a continual debate between capital growth and cash flow, and which is most important. In my own mind, and I know others don't agree, I think early in a person's working career, capital growth probably should be the focus. They're making plenty of money in their job, and really what, in my opinion, they should focus on is growing that nest egg, because ultimately the income they're going to have, let's call it in retirement, whatever that means these days, is going to be a function of the size of the nest egg primarily. So at the age that I am now, I think my focus is logically turning more towards cash flow. And I just feel multifamily investments provide much better cash flow than single family rentals. And that's kind of one of the primary reasons I've made the transition.
Yeah, that makes a lot of sense. So for you then, as you make this shift to multifamily and with the launch of sort of Spark Investment Group, now for you, you're saying, okay, multifamily, from single family, long time single family, multifamily, like, okay, obviously the fundamentals are very, very similar, in terms of, people renting and whatever. I mean, it's not a huge leap. It's a bit different, but, not too far of a stretch. So now as you kind of move forward, what is it? What are your day-to-day activities then? Is it sort of where you've circled certain markets on the map that are more cash flow type markets, and then you're drilling into, okay, who are the operators in this market, and then reaching out to them, or like how does that look?
Sure. Yeah, great question. I'm kind of approaching the proposition on several fronts. So over the 30 years I've been in business, I've helped people invest. I've done fix and flips. I've had investors invest with me for a period of years. So one avenue of approach is talking to my existing database of investors educating them about multifamily investing. Your flip investor is different than your multifamily investor. So I'm spending time educating kind of my current database of investors, as well as using social media and my website to attract new investors to the multifamily space. So that's one aspect of it. Then more the real estate part of it is I live in Greenville, South Carolina, which is kind of in the northwest part of the state. We're 90 miles from Charlotte, which is a great market. We're 120 miles from Atlanta. So my primary focus has been in the Southeast, particularly in the Carolinas. And so I'm constantly reaching out to brokers, also contacting other operators who I know run multifamily projects in the Southeast. So that's been my primary focus. Network with the brokers, reach out to known operators in the area, trying to develop relationships. I also just recently closed a smaller 12-unit property kind of as a joint venture with a couple of my local buddies in Spartanburg, South Carolina, which is about 40 miles from Greenville. So that's kind of what I've been doing. A lot of phone calls with investors, educating them about multifamily, but also about the Carolinas. People kind of know the Carolinas are a good place. And Greenville particularly is starting to get on the radar for national investors. So I think being here is maybe one of my competitive advantages.
Yeah, no, I've heard that. I mean, we've had several guests on of late, that's the same area, right? That they've circled and seems like a lot of growth potential there. So for you then, it seems like, you build a relationship with brokers, you're going to find about who's selling, potentially get some opportunities. So that's when, at some point you're going to get something's going to cross your desk, whether it's an operator who's found a deal, they're going to, more than likely put that in front of you. So what is the process that you're following, or, so you've got those channels, acquisition channels to get some deal flow, but when you get that in front of you, what are the main things that obviously we know cash flow. So your lens is cash flow, but how do you approach that or tear into those materials and sort of assess whether or not this sort of fits your criteria or not?
Yep. Good question. And, I can't say I've totally made the switch to cash flow. Even though I'm 66, I'm going to be here for a while. So capital growth is also important, but the relative importance, I think, has switched.
Sure.
So I think initially I kind of take a look at the overall numbers, check expense ratios. If somebody's showing me a 35% expense ratio, I'm going to probably immediately discount it. I'm kind of an old school guy, so I look at fundamental metrics, price per square foot, price per door. And then also, I have a fairly good firsthand knowledge of many of the communities in the Carolinas. So that plays a big role because there are some that I prefer more than others. Then kind of dive into the numbers a little more, see how aggressive they are on rent increases. One of the things I look at particularly now is the exit cap rate. Because in my mind, so much of the valuation which is based on cap rate, is based on the cost of money. And we're at historically low levels on the cost of money. So, Class A properties, major metro areas are now trading at 4.5% caps, maybe 4.75. B type assets, maybe 5.25, 5.5. C, maybe 5.5, 5.75. And they can only make sense if you can borrow at 3 or 3.5%. So I think having a conservative exit cap provides investors a level of protection against rates potentially going up. I think conventional wisdom says rates are not going to go up for another year or two. I wouldn't be quite as sanguine about rates 5 to 7 years from now when many of these newer things would be sold. So exit cap's a big one to me. I also try to drive every property that I'm of interest in. Last week, I was down in Anderson, South Carolina, which is about 45 minutes away. To me, again, old school, you put eyes on the property and the particular neighborhood. I think you get a much better sense of what's going on than just simply looking at the spreadsheet.
Yeah, most definitely. So for you, if you found a deal, now that it's multifamily, obviously the equity requirement is, the 12 unit, right? You and a couple of guys can do that. But if you find a 50, 70, 100 unit, 150 unit, so would the, kind of moving to like the vision for sort of Spark Investment Group here, right? Like, is that where you'll look to sort of syndicate the equity then, like if it's a deal you control, like because you'll end up being, if you find a deal from a broker you like, you're going to go in and try to take that thing down on your own, right? With your investor group, or?
That's a good question. As I'm relatively new in the multifamily space, I probably have a comfort level, maybe up to a certain level, a certain size property, a certain value. Above that, then I think I would look to partner with a more experienced operator. So I'm kind of proceeding on both tracks. As I think we discussed, I've had a long experience in residential. And so the construction of these garden apartments is similar to single family homes. The leasing is similar. So there's a lot of similarities. But I still think I need to continue educating myself before I'm ready to tackle a 200, 250 unit project, quite honestly. So I think 50 to 100, I would probably look to be the lead operator. Above that, I'd want to partner with a more experienced operator.
Yeah, that makes sense. And then in terms of if a deal, let's say one of these, these other operators in the they bring you a deal like, wow, this looks like a good deal. I like how this looks. Then, how will you look to participate in something like that? Is that where you would look then to say like, hey, I've got obviously money myself. I've got some investors, longtime investors. I'm building even more relationships with investors. Would you look to sort of structure like a co-GP with them where you'd go in and sort of partner with them, or have you contemplated how you would do that?
Yeah, so that's exactly how I would do it. So to date, I've completed one co-GP syndication on 167 units in Augusta, Georgia. I'm currently in process on 3 other investments as a co-GP. We just fully funded the second one, and that will be closing mid-February. And that's a local one in the Greenville MSA with some operators I've known ever since I've been here. So there's a good comfort level there. As co-GP, I typically put up some of the earnest money deposits, so capital is at risk. I go on site to do the due diligence and walk the units and review the leases, review the underwriter. I'm certainly not the chief underwriter, but we set up and I query them about what assumptions were made and why. And sometimes I challenge them and we have a discussion. And so I try to come to an understanding of how they're calculating their numbers, with the notion that particularly in this environment, a little bit more conservative underwriting is called for. being in the business 40 years, I've been through lots of economic cycles. I don't need to recite all of them, but I've been through quite a few. I paid 11 and three quarters on my first house. Okay. I sold houses when rates were 16 and a half. So I've been to a few rodeos. And what I would say is the syndication space is kind of blowing up in the last 10 years.
Yeah.
And it's also true in the last 10 years until COVID hit, we kind of had unprecedented economic growth.
Yes.
So if you couldn't make money in real estate during that time, you must be really doing something wrong. Okay. As my dad used to say, if the market was hot, anybody could lean up against the house and sell it. It's slow that you need some talent. So I think natural economic cycles and the lingering effect of COVID would tell me we can't expect the same kind of economic growth we had the last 10 years. And therefore, the underwriting needs to be more conservative. And I think investor expectations need to be a little more conservative. If I see some crazy IRR, that's actually almost a turnoff to me.
Yeah.
It's alarm bells going off. Yeah, I love being involved in the process, doing the due diligence and walking through all those units. You really get a sense. You meet a lot of the tenants, you meet the property managers. You really kind of get a sense of what's going on and what's possible, what the potential is, and what you can do with the property.
Yeah, no, I agree. Yeah. And that is, and I think that's just it. It's become, all the guests I interview and stuff, it's popping up more and more, right? It's becoming a team sport. And I think I mentioned to you before we hit record here, right? Same thing, like just seeing the amount of collaboration that's taking place, amongst the participants as this thing grows, I think is all a good sign. Because to your point, I mean, that's what it is, that it's good to have people to push back against, right? To have kind of that push and pull. Like you said, I mean, you've what you bring to the party is experience. You've been to a few rodeos, right? And, that is an invaluable sort of thing, to be like, okay, and I know right now it seems, whatever, you've got sort of that recency bias of, man, exactly. We just crushed it and everything was just a home run. And now, you're not realizing like, yeah, but we're in the middle of a global pandemic. And, like as much as we want to believe that, maybe this thing can bounce right back. It's just, if you've been around long enough, what, that's not generally how it goes, right? Like it's these things have a lingering effect. Like you said, I mean, you've had a home mortgage from a conventional lender at, 11%. You sold the house to someone who had to pay 16. Like, that's nuts. That's called like the hard money, right? Like now, but in the Reagan era, that was just called life,
Yeah.
So it's,
yeah. And it, yes. And I really enjoy the team aspect of this. For me, I'm at a time in my life, I'm financially secure. And I'm blessed to be in that spot. I have great health. I'm expecting to live another 30 years and I want to have some fun. I want to keep using my mind. I want to help other people kind of have the life balance that I do. And then it comes down to recognizing your own strengths and weaknesses. And that's where the partnership and the teamwork come together. I'll be the first one to admit, I'm not the most organized guy. Okay. It's just not, it's not kind of in my DNA. Well, with the couple guys that I JV'd in the Spartanburg deal with, they're all 35 to 40-year-old engineers. And I love working with them because they got everything in the Google Drive. They've got the spreadsheets, and I can just kind of do my thing. And they want to learn the real estate business. So it's a win-win. They're starting their investing career. So they enjoy working with someone with more experience. I love helping them learn about investing, and I sure as heck appreciate the support they give me to handle some of the things that I don't enjoy or I'm not best at. So I really love kind of the teamwork. It's a real fun part of the business.
Yeah, that's great. That's one of the things. So I've got, an ebook I wrote sort of on for investors, some checklists, like here's the things you need to look at, sponsor level due diligence stuff. But one of the big things that I think is super important, right, is that assess the team, right? Especially given whatever the strategy. So as a good example, I think it just always comes to my mind is acquiring, kind of a value add mobile home park sort of deal is a great example. If you assess the players in the team and none of them are, above average or excellent communicators, there's a really good chance that you could run into an issue trying to turn around a mobile home park in particular, because the dynamics that exist inside of a mobile home park, you've got park-owned homes and non-park-owned homes, and you've got these people who've been there for years, and you've got transient people, and you've got whatever. Like if you go in there and you start pushing rents and you don't have a communications plan and you don't have those things, the same can be said in value add multifamily too. But I just think that it can't be overlooked. Yeah, it's like the ability to do the analysis and the ability to be a good negotiator and to know real estate. Like, yes, you need all those things, right? But like you have to look at it. Does the team that's doing the deal, it's expected to execute the business plan, do they have the right people? It's one thing to go buy some core asset, right? That's like 100% occupied. You're not going to push the rents. And like, you know what I mean? Like, it's just like, I'm not saying it's easy, but it's like, it just like, it doesn't require as much. So you have to look at it. Like, what is it? Where is it? Even like you said, like, I mean, you point to it, you're going, hey man, I'm really familiar with all these submarkets in, neighborhoods in the Carolinas. I like some, I don't like some. It doesn't mean they're all great. Just because some, website said that, Charlotte's the greatest thing since sliced bread doesn't mean that every area in Charlotte is great. Right. And so it's just, those things matter, and you have to sort of assess it in its totality to determine whether or not, it's going to be successful. Because even if it is like a really great team that's trying to execute a strategy in something that they don't have enough experience in, those things can go sideways, I've seen it. I've seen guys who are really great at just buying, value add multifamily. They know the market, they know whatever. And then they go to do their first development deal and it don't go so well. And it's like, to you, you've been in the business so long. It's like, that's not shocking to you. Right. But to some people, they just think that those things are going to perfectly translate. It's like, no, it's different. You got entitlement and municipalities and all these things that they never had to deal with that they suddenly have to deal with. Right. And it's general contractors and all the subs. Like, yeah, did you have to manage some subs and whatever? Sure. Like in your sort of value add play, but it's nothing like coming out of the dirt. It's completely different.
I've never done any ground up development. I almost did. I subdivided some lots in downtown Greenville, was ready to build. This was back in March. Was about to sign the contract with the contractor. So this is 40 years. I'm going to build 3 houses, big whoop. COVID hit, my financing dried up, and I just sold the property and put it into some multifamily. And just to piggyback on your statement about the importance of teams, one of the things I've looked at as a limited partner and also as a co-GP, has this team been together before?
Yeah.
Right? Have they done 2 or 3 other deals? Because you have to know that the team and the personalities are going to work. So if this team has been in place and they've done 5 or 6 deals and they're all operational, you have a pretty good sense where you could have you could bring 2 great people together, but have never worked together. You don't know if they're oil and vinegar. So I prefer to invest with either as an LP or a co-GP with teams that have been together. So I have a sense these guys know how to work together, and they kind of have clear roles and responsibilities, and the personality personalities don't get in the way, where with newly formed teams, you just don't know what's going to happen under the pressure of the deal.
Yeah, most definitely. Most definitely. So where can folks find you, Arn? So how can they learn more about you and where to find you and get involved in what you're doing?
Well, and Lance, thanks for having me on the show. I really appreciate it. So my business is Spark Investment Group. The website is investwithspark.com. And if you go there, you can get a little PDF about why I prefer multifamily over single family. My email is arn@investwithspark.com. And in homage to the Bay Area, I've kept my old cell phone number, 650-575-6114. Reach out, give me a call. Love talking to real estate, love talking investing with anybody, and happy to help in any way I can.
It's great. Well, I've really enjoyed having you on the show, Arns. Thank you so much for joining us, and you have a delightful day.
Same to you. I learned a lot, Lance.